The market is focused on the size of the debt. The real question is who will be forced to absorb it and on what terms. Countries like the United States rarely blow up in a clean default. They change the rules slowly, then ask savers to call it stability. I have sat through enough financing discussions to know that headline numbers mislead. $36 trillion sounds theatrical. So people either panic or tune out. Boards do that too when leverage gets large. The useful question is always the same. What makes the funding base wobble? For America, the hazard is not that Treasury checks suddenly bounce on a Tuesday morning. Washington issues debt in its own currency and controls the printing press behind the curtain. The deeper risk is political. It can dilute obligations, cap returns, lean on institutions, and present the whole exercise as prudent stewardship. Economists have a polite term for this family of tactics: financial repression. It sounds like something drafted by a committee that wanted nobody to notice. In practice, it means keeping interest rates below inflation, nudging banks to own government debt, and trapping domestic savings inside the system long enough to cheapen the burden. Even if nobody used the label at dinner. After World War II, the United States held rates down while inflation and growth eroded the debt load. Britain did similar work for years. Savers supplied the sacrifice. Governments called it normalization and moved on. That is the risk economists often sidestep in public. It lacks the drama of default and the elegance of a spreadsheet projection. It is distributive. Somebody pays. Usually pensioners, wage earners, insurers, and anyone holding long-duration assets while policy quietly changes the value of time. Watch how the language is framed. Officials talk about resilience, market function, affordability, and protecting demand for treasuries. Fine words. I used plenty of fine words in restructuring meetings myself. They often mean management has chosen which constituency gets hurt first, and would prefer not to say so plainly. The Treasury market is the foundation under almost every asset you own. Mortgage rates, corporate borrowing, equity valuations, private credit marks, bank balance sheets. All of it references that supposedly risk-free curve. When the sovereign debt stock grows faster than the economy for too long, the foundation does not disappear. It gets more sensitive. Sensitivity is where the trouble begins. A 1% move in rates now carries far larger fiscal consequences than it did 20 years ago. Interest expense crowds out discretion. Then policymakers face a choice every over-leveraged management team eventually faces: accept pain honestly, or engineer a softer-looking answer that lasts longer. Politicians prefer the softer-looking answer. That is not cynicism. It is observation. Tax hikes are visible, spending cuts are unpopular, and default is unthinkable. So the menu shifts toward inflation tolerance, regulatory pressure on captive buyers, central bank accommodation in moments of stress, and a steady campaign to keep nominal growth ahead of funding costs. You can already see the captive buyers lining up. Banks hold treasuries for capital and liquidity purposes. Money market funds are wired into the plumbing. Pension funds need duration. Foreign central banks buy for reserve management, then pause when geopolitics intrudes. When voluntary demand weakens, policy has a habit of making demand less voluntary. That phrase sounds severe, but I mean something precise. Rules change. Capital requirements reward sovereign paper. Liquidity standards privilege it. Collateral frameworks elevate it. None of this arrives with a brass band. It comes in technical language, usually after a period of market strain, when the public is eager for anyone to restore order. If you want the board version, here it is. The debt problem becomes dangerous when the state must choose between honest pricing of capital and social peace. Honest pricing would mean higher yields, weaker asset values, slower growth, and budget triage. Social peace usually wins the vote. Capital then gets managed rather than respected. That is why the inflation debate matters more than the debt ceiling theater. Debt ceilings are Washington's version of community theater. Little suspense. Persistent inflation does the real work. 3% to 4% inflation, sustained while policy leans against comparable nominal rates, erodes obligations without ever mailing a default notice. People object that markets would never tolerate such manipulation for long. I would remind them that markets tolerate many things when the alternatives are worse. I watched investors buy poor paper in the 1980s because regulation, benchmarks, and career risk made refusal expensive. Human beings do not need enthusiasm, they need constraints. The international angle matters too. America's reserve currency status buys time, flexibility, and an extraordinary benefit of the doubt. It does not repeal arithmetic. If foreign holders decide treasuries offer poor real returns and rising political risk, domestic institutions must absorb more supply. Then the pressure to guide, incentivize, and channel savings rises at home. This is where ordinary citizens feel it, without always identifying the source. Your savings account trails inflation. Your bond fund delivers meager real income. Your retirement plan owns assets priced off a sovereign curve that no longer reflects clean market discovery. You are told the system is stable. Your purchasing power files the objection. The unsettling part is that the process can coexist with strong markets for stretches. Equities may rise, home prices may hold, credit spreads may behave. Asset buoyancy with national solvency all the time. I have seen highly leveraged companies trade beautifully right up to the quarter when financing freedom disappeared. So when someone asks whether America can sustain its debt, I answer with a different question. Sustain it for whom? The government can fund itself for a long time. The issue is the terms imposed on savers, workers, and institutions while it does so. That transfer will be called policy. It will feel like erosion. I have seen this pattern before in companies, countries, and ministries with better tailoring than discipline. The formal promise remains intact, while the economic substance changes under your feet. That is the real risk in U.S. debt. Quiet default by other means. Where does the official story break down for you?